Hey folks, welcome to a product review at Finominal. Today we're going to look at research-driven funds. Now, what is a research-driven fund? It's simply that the large asset managers like a JP Morgan or T. Rowe Price, that they have departments full of equity research analysts that know companies very well, have been covering them for many years or even decades, and you can put together a portfolio of the kind of high conviction buys or like the best ideas and put that into a mutual fund. And so we have four of these funds from Janus Henderson, JP Morgan, T. Rowe Price, and Putnam, and going to see how valuable the research is, and like if these high conviction best idea funds have actually performed. We are going to kick off with the holdings-based factor exposure analysis, simply to see how similar or different the underlying portfolios are compared to a benchmark like the S&P 500. Now, from a pure portfolio perspective, we do see that these portfolios are more concentrated. So, for example, the portfolio from Janus Henderson only 84 stocks, compared to the portfolio from T. Rowe Price with 331, but less diversified than the S&P 500 as expected. From a holdings-based factor exposure analysis, so we do see the characteristics of the underlying portfolios, but what we also see is that kind of most of those dots are in the center, which is effectively right how the portfolio of the S&P 500 is positioned. Now that effectively means that three funds here, and specifically those are the ones from JP Morgan, T. Rowe Price, and Putnam, are not very different from the portfolio of the S&P 500. In contrast, the fund from Janus Henderson with the ticker JNRFX, that is differentiated. And that tends to have companies that are larger from a market cap perspective, a bit more expensive, more growth, high momentum, but also more volatility, but also high from a quality perspective. Now, this is the holdings-based factor exposure analysis. We can also go back in time, and we have 28 years of track record. And so this is a returns-based factor exposure analysis. Having said this, this practically mirrors the holdings-based factor exposure analysis in the sense that we see almost no factor exposures, so factor betas to be precise, for like the products from JP Morgan, T. Rowe Price, and Putnam. We do see some exposures for Janus Henderson, right? It has a negative exposure to value, slightly negative exposure to low volatility, and a positive exposure to quality, right? So there's a certain growth aspect of this fund. The other point that's worth mentioning about the product from Janus Henderson is that it has a beta of 1.1 to the S&P 500. So that makes it more volatile, and you could look at it like a little slightly leveraged bet on the stock market. Now, we can also have a quick look at sector exposures, and it is worth mentioning that sector exposures follow factor exposures. And given that we already see that three of those products are very undifferentiated from the S&P 500, despite being more concentrated from a number of holdings perspective, the only real difference here is the product from Janus Henderson again, where you have a massive bet on technology stocks and basically underweight to pretty much everything else. Now, that's from a portfolio perspective. Now, let's move on to performance and risk. So here we see, well, a track record going back to, what is this, 1997. And effectively, you see that two of those products, have almost, and this is one from JP Morgan and the one from Putnam, have effectively generated the same return as the S&P 500. The product from T. Rowe Price has performed slightly worse, right? While the product from Janus Henderson has outperformed. Now, on the first look, this is great, but we do know, right, that the product from Janus Henderson has a more differentiated portfolio, right? And that does not only reflect in a higher return, right, a higher CAGR, right, but also a much more volatile portfolio. And that effectively leads us to Sharpe ratios that are virtually undifferentiated. So although Janus Henderson had a higher return, its Sharpe ratio at 0.47 is lower than that of the S&P 500. And the same applies for the other ones. So the Sharpe ratios are either lower or marginally higher for the one from JP Morgan, that effectively none of these funds has achieved over this very long period of 28 years to produce higher risk-adjusted returns than the S&P 500. Now, James Henderson might argue, well, but we have achieved a higher return, doesn't it count for something? Not really. So we do know that the characteristics of the product from James Henderson is effectively a more growth-focused portfolio, and we can simply look at a kind of like a growth-focused fund. Here's one from Vanguard, VUG, right, which is I think the largest, second largest smart beta ETF out there. And what we can see is that the performance of JNRFX, which is a product from James Henderson, effectively is almost identical to the performance of Vanguard's product. And Vanguard's product is much cheaper at 4 basis points than the product from James Henderson. So there's either the performance, we can explain it, and unfortunately there's nothing unique about it. And so this kind of concludes our analysis of these 4 research-driven mutual funds. So as discussed in the introduction, the idea is to get the best ideas, the high conviction buys of the primarily fundamentally driven research analysts of these very large asset managers. But it seems that unfortunately they have not contributed much value over 28 years, which is a long time frame, or the fees are too high, or a combination thereof. And it's also a reflection that simply that the US stock market is highly efficient, very competitive, and well, that there's no real alpha left. Hope that helps. Have a nice day.